What's going on, everybody? Stas here. Welcome back to another video. So today we're going to be doing a WeBull options trading tutorial going over how to understand the options Greeks. And let me tell you guys, when I first got into the stock market, dabbling into options trading, I had zero idea of what the Greeks were. What the heck is delta, gamma, theta, vega, rho? How do these different Greeks affect the options prices? So I want to talk about that in today's video, make it very simple for all you guys out there, especially beginners, so you understand exactly what I'm talking about. So if you all find value in the video, hit the like button, subscribe to the channel, join our free Discord chat, and make sure to also get your free stocks from WeBull down below. And let's get right into it, starting off here with Apple, ticker symbol AAPL, and this is what the options chain looks like here on the WeBull desktop app. So the five Greeks, first and foremost, let's get right into it, guys. The five Greeks are delta, gamma, theta, vega, and rho. And you guys can see them right here at the top: delta, gamma, theta, vega, and rho. And in general, what you guys have to know about these Greeks is they tell you how changes in certain factors will affect the options price, right? And options price, speaking of that, is the premium of what you actually pay for the option. So let's say, for example, we're going to end up buying some call options on Apple, right? And let's say we're going to look at the April 16th, 2021 call options, which are 153 days out. And let's say we want to look at the $130 strike price. So that means pretty much that, okay, I'm bullish on Apple. I think by April it's going to be above $130. So for this particular option, we see the delta is 0.38. Gamma is 0.01, the theta is negative 0.03, we have vega at 0.29, and rho at 0.16. So we're going to talk about delta first here. And delta, very simply, guys, is how much the option moves for each $1 move up or down, right? For each $1 move, the stock goes up or down. So in this case, we're going to be paying $6.15, but oh no, we're not, because we're going to have to multiply that by 100, because each contract here is 100 underlying shares. So we're going to have to multiply that by 100. So one contract of Apple at 130 strike price is going to cost us $615. That is what we're going to have to end up paying here for this Apple contract. So let's say, okay, Apple's trading at 119. We buy this contract, and then Apple goes up $1 per share to $120. So that is going to move the contract by, or the premium that you paid, by what the delta is here, because the delta, again, it shows you how much the option moves for each dollar move up or down. And you could also multiply the delta by 100 to make it easier. So if we multiply that by 100, that's going to be around $38. So let's say Apple goes from 119 to 120. This premium is going to go from 615. You're going to have to add the delta to it, and it's going to be roughly, if I can do the math in my head, about 653, right around there. So you're going to add $38 for each dollar move that goes up in the stock. That is very, very simply, in simple terms, what delta is. And if the stock goes down, it obviously works against you, right? You're going to have to subtract about 0.38 from that premium for every dollar that goes down. So that is very simply what delta is. It really just shows you, again, I can't reiterate it enough, how much the option moves for each $1 move up or down. And you could also use delta to actually estimate an option's probability of expiring in the money. So in this case, okay, what are the options probability? What's Apple's probability of getting to $130 by April 16th, 2021? About 38%. That's what the delta says here, 0.38. And the further down we get on the options chain, it actually shrinks. The chance, the probability of Apple getting to, let's say, $145 is only 20%. So half of that almost 40% at $130. And if we try and get to $160 by April, it's only 10%. So the farther out of the money your strike is, the lower and lower the chance of it actually expiring in the money by that particular date. That's kind of an interesting way you can use delta there. Again, it shows you how much it moves for a dollar move up or down in terms of the stock and the premium. And you could also use it to see the probability of it expiring in the money. So that is what delta is, guys. Very simple right there, right? And gamma is the rate of change for every dollar move of the stock. So let's say, for example, okay, Apple goes up from 119 to 120, right? We're going to add the delta on to the premium. So 38 plus, 0.38 plus 615, we add that onto there. Then for every other dollar that goes up, we're going to add the gamma to the delta and then add both of those to the premium, right? Because again, the gamma measures delta's rate of change for every dollar move of the stock. Very simple. And for every dollar move after that and after that, you just keep on adding the gamma to the delta back to the premium, gamma to the delta back to the premium, gamma to the delta back to the premium. And again, this works against you as well. That's if, okay, the stock goes down instead of up. That's if you're doing call options, right? It works against you if the stock is going down. So delta and gamma, those really deal with the price, the rate of change, and how much the price of the stock is moving. That's kind of, what that focuses on. And theta, this is extremely important, guys. Theta deals with time decay. And when you're trading options, not only do you have to pick the right price that you think the stock's going to go to, you also have to pick the time frame that you think the stock's going to get to that price. There's two parts to the equation, right? You pick the stock's strike price, and you pick when you think it's going to get there by. So that is interesting here. And every day that goes by, pretty much, you're going to have to subtract the theta from your premium. The theta right here is 0.03. So you're pretty much losing $3 every day off your premium because, again, you have to multiply all these by 100. You're losing $3 off of your premium each day that goes by, each day that you get closer to the expiration date. That's if you're buying call options. If you're selling, which is a completely different game, and I'm not going to get into that in this video, if you're selling options, well, the theta actually works in your favor. It works in your favor because you're on the complete other side. You're actually selling options to people that are buying them, that think the stock's going to go up. And if it doesn't, right, if it doesn't go up, each day eats away at their premium, but you're actually making money on the flip side if you're selling those contracts, if that makes any sense. And I don't want to get too advanced again because this is not an advanced video. This is more beginner focus. All you have to understand is theta shows you how much an option loses money, how much value it loses for each day that goes by, because again, options are very time sensitive. You have to understand that. And then after theta, up here after theta, we have vega. This estimates how much the premium will change with each 1% change in implied volatility. And implied volatility pretty much shows you that, okay, traders out there, options traders, they're expecting a pretty big move in a stock or not, depending on how high the implied volatility is. And implied volatility can spike in different scenarios, such as earnings reports, when there's, tension in the markets, there's tension in different sectors, industries, if the stocks are very hot or not, that could really, change implied volatility for those, stocks and the options, right? And the further out a options expiration is, the higher the vega will be, and options with longer expiration may react more to a change in the implied volatility. So for me, guys, I use these four mostly, delta, gamma, theta, and vega, to actually do my option analysis to see, okay, how much an option will move up or down in this scenario, that scenario, right? But there's another one called Rho, which deals with interest rates, and I don't really use this one too much, but it's still one worth looking at. Rho is the rate at which the options price, the price of the derivative, which is the options price, changes relative to a change in the risk-free rate of interest, right? So it really just deals with interest rates, how interest rates are fluctuating, how that is going to affect the options price. But again, I don't look too much into this, and Rho actually measures the sensitivity as well of an option or options portfolio to a change in the interest rates. So that's really it, guys. I mean, it seems complicated, but it's really not. All it is really a math equation, right? That's all it really is. And for each dollar move in the stock, you got to think to yourself, okay, I'm going to add the delta, and then for every dollar after that, the rate of change, I'm going to add the gamma on top of that. And then for each dollar day that goes by, I'm going to have to subtract the theta, and then Vega comes into play with implied volatility. So it really all it is, it's not some complex, calculus equation, nothing crazy. All it is simple addition, subtraction for each day that goes by, for the implied volatility change, for each dollar move that we see. So that really is all that it is. And let's do a quick rundown, a quick little breakdown and refresher to talk about exactly, again, what these are in under 30 seconds. So delta is going over how much the option moves for each dollar move up or down, right? Gamma shows and it measures the delta's rate of change for every dollar move of the stock. Theta talks about time decay, measures delta. It estimates how much value an option actually loses with each day that goes by. And Vega deals with implied volatility, as Rho deals with interest rates. So that's pretty much it, guys. Nothing too crazy. Let me know down below in the comments. Do you have any questions? I'd love to answer your questions down below. Make sure to hit the like button as well if you guys found value in this video, and I'll catch you all in the next one. And again, make sure to subscribe to the channel. Thanks for watching. As always, stay safe out there. Good luck in your options journey. Peace out, guys.